I'm going to try. I think we're a little bit behind. I'm going to try and get us back on. I'm going to go through this as quickly as I can, so hopefully you get your speed listening ears on. But I think this is obviously a resource conference, a metals and mining conference, which is fantastic. You're like, what is a real estate guy doing here? Well, I think you'll find that out in just a minute. I discovered the benefits of having precious metals in your portfolio the hard way. After 2008, I was very heavy in real estate and didn't have any insulation. I think it's a time to start thinking about how to insulate yourself. So I'm taking the lessons that I learned from what happened in 2008 and applying them to what's happening right now. I hope you'll find some benefit. Don't have anything to sell you. We have a radio show. I'll tell you how you can listen to that. It's free. I'll have some free reports for you. But I'm really not here to pitch anything. I'm just here to share some ideas with you, things I wish somebody would have talked to me about 15 years ago. You can find our shows, our little blue logo, on any podcast site. It's Real Estate Guys Radio Show. You can get us on iTunes and all these different places. So the big question in everybody's mind, I think most of us, even though this may be metals and mining, most of us own real estate, and we have to ask ourselves, are we in a bubble? Well, if this is a U.S. housing chart, but if you look at the chart, you'd have to make the argument that that looks like a little bit of a bubble, especially when you consider that this was 2008, and you can see the size of that bubble relative to where we're at today. Okay, so it's a concern, right? The equity is fickle. The market giveth, and the market taketh away. And, when you look at your balance sheet and go, oh, yeah, my house is worth all this, and you go spend all your cash and then realize that the equity goes away, that's when you find yourself in trouble. So what if there was a way to harvest that bubble equity and insulate it while putting yourself in a position to profit in case there is an asset price decline, not just in real estate, but in anything? So in other words, is there a way to protect that equity, to take some profits off the table without having to give the property up? And I think the answer is yes. So I had a chance to sit on a panel with Daniel DiMartino Booth, George Gammon, and Chris Martenson, if you follow any of them. Last year we produce a conference every year. We call it our annual investor summit. It used to be at sea on a cruise ship. The last couple of years we've done it at our resort development in Belize. And Danielle and I sat on a panel, and I asked her, I said, is the Fed going to keep raising interest rates until something breaks? And if so, what's going to break? And she said without hesitation, the Fed will keep raising interest rates until they break the credit markets. And I thought, ooh, remember the last time the credit markets broke? That wasn't very good for real estate, so I paid attention. And so you have to ask yourself, are we sailing into a storm when it comes to credit markets? If you saw when I was on the panel this morning, Brent Johnson talked about being concerned about sovereign bond crisis and currency crisis. And the question is will the people who print the currency use the currency printing press to save the bond market, or will they let the bond market fail? I think they're going to save the credit markets at the cost of the currency, which is why metals play such an important role. But when the credit markets come out of real estate, that's when the asset prices crash. It wasn't a subprime problem. That's not what happened. It was a credit market crisis that was triggered by a subprime problem. So here's the situation we've got. When you have rates rise as quickly as they have, that yellow line on the right-hand side, that is a lot of stress. You can see they tried to raise rates in 2016 after having been flat for quite a while. They got it up to a point in 2019, and then it chugged along until the end of 2019, and then something happened. We're going to talk about that in just a minute, and they had to drop all the way back down to zero, and it stayed there until now. And so in 2022, they began aggressive hiking, and that's where we are right now. So it begs the question, what happens next? When I was a little kid, I used to play this game called Mousetrap. If anybody's old enough to remember that, you'd have this whole mechanical setup, and then you'd put this ball in motion, and a series of events would occur, and if you weren't paying attention, that little trap would come down and capture the mouse. That's what happened to me in 2008. There were all kinds of things happening up in the macro, and I didn't have any idea what they were, what it meant, until I got trapped, and my mortgage company was put out of business, and my real estate portfolio imploded. I had no working capital because I didn't believe in cash. I had credit. But when the credit markets collapsed, I had what we call single point failure. Everything I did, I brokered credit, I built on credit, I sold on credit, I ran my business on credit. When credit markets died, it was like having a massive heart attack. All circulation stopped, and it wasn't just me, it was a lot of people. So I became obsessed with trying to understand this. And I think I have a good understanding of it today. I'm not on the caliber of some of the people I was on the stage with today, but I'm learning. At least I earned the right to be on the stage. So if you don't understand all this stuff yet, I'm living proof you can figure it out if you just pay attention. The question is, what can we do to avoid trouble? Well, the first thing, I think the most fundamental thing, and this might be old hat for a lot of you, but this was really understanding this one principle helps you unravel a lot of what's going on systemic. When they talk about systemic risk and contagion, it's all based on this one principle, and that is when rates rise, bond values fall. And bonds are the credit market. And so if you realize when you're rapidly raising rates, anybody could see what was about to happen, and it's exactly what did happen. 2022 was the worst year ever for U.S. bonds. The safe haven became a very dangerous place to go for capital preservation. Yeah, you get your dollars back, but they're not worth anything. And of course, if you have to sell the bond in a high-rate environment, the principal value has dropped. So it's a problem. It's an even bigger problem when you realize that there were trillions of bonds issued before the rate increases started taking place. $237 trillion in bonds were out there as of 2017 before they really started aggressive raising. 2019, they hit the peak of the first cycle of rate, and you know, to no surprise, there's stress in the bond markets. Okay, well, what happened here at the end, September of 2019? Anybody remember that? Yeah, something happened. Something happened that triggered a whole series of events. And some I've heard, with a little tinfoil hat on, that COVID was actually a cover to give them an excuse to try to fix what was going on in the financial market. I'm not saying that's what happened. I'm not that smart. Correlation isn't causation, but something happened. So here's a hint, if you remember the old game Jeopardy. This happens when big balance sheets are loaded with leveraged bonds and bond values implode. What is a mad dash to cash triggered by trillions in margin calls? Have you wondered how in the world can they print so many trillions of dollars and have the dollar be strong? Where's all this demand coming from? Meanwhile, the rest of the world is trying to de-dollarize. Well, there's a lot of margin calls going on. The financial system is extremely fragile right now. More fragile than I think the powers that be want you to realize, because it would trigger a panic. Right? And that's actually Jeremy Irons from the movie in 2011, Margin Call. All right? So what happened in 2019, the end of 2019, was the repo market imploded. The Fed had to step in. Interest rates in the repo market was overnight lending in securities. It's like a pawn shop for hedge funds and big holders of treasuries. They don't want to sell their treasuries because they got to realize the loss. So what they can do is they go into the repo market and they pledge them and borrow overnight. The interest rate went from 1% to 10%. That's 1,000% risk premium increase. Like something was clearly wrong. Extreme counterparty risk. And the Fed stepped in and put in hundreds of billions of dollars a day. At the peak of QE, they were doing $120 billion per month. But in the repo market at the end of September 2019, they were putting in $100 to $200 billion a day. So, I mean, that, you know, you don't even have to understand anything, because something's wrong. Something's broken. And it said right there, banks couldn't quickly fund market when rates spiked. So it's a liquidity crisis. So this is what happens. So here's the way the mousetrap works in summary. Okay, rising rates crush bond values in a world of record debt, right? That's not conspiracy theory. That's not conjecture. It's pretty easy to see that that's the case. We know that leveraged bonds destroy balance sheets. Any amount of margined paper assets on a balance sheet when asset prices drop triggers margin calls. That's a liquidity crisis. And then there becomes a huge demand, and then, you know, everything starts selling, and it becomes this vicious downward cycle. In 2008, the Federal Reserve had to step in with an $800 billion balance sheet and buy $4 trillion worth of securities to put a bottom in a bond market in free fall. All right, and that's because there's extreme counterparty risk. Nobody wants to loan anybody any money. There has to be a borrower of last resort. And so the net result is what Danielle DiMartino Booth told me would happen. Credit markets seize, not just tighten. We have tighter credit markets today. Seize, where they're just completely dysfunctional. So I went back to 2008 and I wanted to see, you know, because history doesn't repeat itself, says Mark Twain, but it often rhymes. This is a article from CNN Money, December 31st, 2008. It says credit 2008. Year of the freeze. Credit market endured a disastrous year in which the pipes of lending practically froze solid. So if you look at your portfolio, if you look at your business, if you look at your investments, and you are dependent upon healthy credit markets, get ready. You don't have to be victimized by it. I had a lot of friends that made a lot of money in 2008. I wasn't one of them because I wasn't ready. Part of my mission being here today is to help wake you up and have you consider the possibility that credit markets could implode. I'm not saying they will. I'd say it's probably more than a possibility, maybe more of a probability. We don't know, but you need to be prepared. So specific to housing, which is kind of the area I live in, this is what it looked like. So housing prices peaked in 2007, and that is the GFC, the Great Financial Crisis, the real estate crash of 2008. That's what that looked like. It fell from, whatever that peak was down to that trough right there where it broke it back down to the trend line. Okay? Now, it took about 5 to 10 years, depending on what market you were in, before your equity came back. When you lost your equity, it was like, oh my God, we're devastated. And if you were upside down, negative cash flow, it was ugly. I was one of those guys. But if you could hold on, if you had control over the cash flow, actually, you did quite well. The market healed itself. They reflated those assets. Okay? But it took some time. All right? So then I did something interesting. I took a look at gold and housing. I don't know that anybody's ever done this type of correlation. Again, correlation isn't causation, but it's interesting. So here's the housing price, 2007 to 2012. And here's gold lined up exactly the same. And a funny thing happened. When real estate was going down, gold was spiking. And I don't think it's because people were taking money out of real estate and putting it in gold. I think it's because the bond markets were collapsing, and the reaction to real estate and the reaction to gold when bond markets struggle is very different. Very different. And so if credit markets and bond markets are going to implode because of rising interest rates, I wanted to look back historically and go, what is the effect going to be on real estate, and where might I take that equity and put it to keep it safe? And so what I've been doing and teaching people is to reposition equity from real estate, which I consider to be bubble equity. It's very dependent upon the air pump of the credit markets pumping air into the jump house. Somebody trips over the cord by raising interest rates, all that comes out. But what if there were a way, knowing it was coming before the prices dipped, to move into gold, knowing that there was a probability prices, the value would be retained in gold? Obviously, we're a little bit into the cycle, and I think the thesis is proving itself. Real estate prices have been declining. Gold prices have been improving. I think the setup is exactly the same. Again, I'm not smart enough to say that I know what the reason was, but I did see the correlation, and now it's beginning to repeat itself. So here's the game plan. I want to give you something practical that you can go home and do. This is a thing that a lot of the people who listen to our show are doing. The idea is you're going to harvest some accessible equity via cash out refinance. The equity's there, get some chips off the table. You don't have to sell the property to get them. You don't have to realize profits and gains and pay taxes. You just got to get liquid. Okay? You're going to use a fixed rate and term loan for at least 10 years. Why? Because you know it's going to be potentially in a worst case scenario like 2008, probably 5 to 10 years before that property comes back. If you were to have to sell it and pay that loan off, you'd be cash out of pocket. Now, the thing is, you're not going to spend the money. You're just going to recharacterize your balance sheet, and I'll show you what that looks like in a minute, too. All right? There's that 10 years. Okay, so now what we're going to do is we're going to use the tax reduction, because we get tax deductions. It's supposed to say not, it's a typo. It's supposed to say deduction, not reduction, but it effectively does the same thing. And we're going to use high-yield notes in order to mitigate the debt service. I'll show you what that looks like in a second. And we're going to buy gold bullion. We're going to take physical possession, which I think most of you probably understand the difference between paper gold and physical gold. And in the United States, anyway, we can put it in a qualified retirement plan, which is nearly bulletproof for asset protection. However, it's like a Roth-type plan, and that gold goes from $2,000 to $20,000. There's no income tax. So I don't know what you have here in Canada, but look for places you can put it where you can mitigate some of the tax. Okay? So let's do the math. This is what the cash out looks like. I just made up numbers. If you have a bigger property, add a zero. If you have a smaller property, take a zero off. The principle is the same. We're going to leverage that property. Say it's worth $500,000. We're going to take an 80% cash to value, loan to value cash out. Pull $400,000. We've got $100,000 of equity left in the property. Okay? Now we're going to take those proceeds of $400,000 and we're going to purchase $200,000 of high-yield notes. And don't worry, they exist. You may not know they exist, but they exist. People make real estate-backed loans all the time in the private market, and the yields are well above anything you'd get at a bank or in a bond market. Okay, and then we're going to take the other $200,000, we're going to purchase gold. All right? So we have zero cash remaining. So here's what your balance sheet looks like before. Before you had a $500,000 property or $500,000 of equity in a property. You had no notes, you had no gold bullion, and you had $500,000 in total assets with no debt. So you have a $500,000 net worth, okay? $500,000 net worth, all right? That's your portfolio mix. You got $500,000 in real estate equity, which I would argue is air. Can't really use it, can't do anything with it. The market can take it away if somebody trips over the jump house pump, which is what rising interest rates does. It's illiquid. You can't get to it. You have to borrow or qualify to borrow it out if you want to use it. It's public. People can look up and see who owns the property and see that it has equity, which makes you a target, and you're exposed to things like lawsuits. If it's a rental property, a trip and fall, your dog could eat the neighbor's cat. I mean, there's all kinds of things that could happen. Your assets are exposed. So it's not a great position to be in. I'm a real estate guy. I love real estate. Not a fan of having equity in a property. Now, what we're going to do is take a look at your balance sheet after you make this move. You're going to have a $500,000 property. You're going to have $200,000 of notes and $200,000 of gold bullion in a safe. Total assets are $900,000, and you put a $400,000 lien or mortgage into the portfolio mix, and you still have a net worth of $500,000. We haven't spent the money. We've just recharacterized our balance sheet. Okay, I'm going to make the argument you've made it safer. You've made it more resilient. You've made it insulated from a collapse in the credit markets, which is the risk we're trying to manage for. All right, so here's what your portfolio looks like now. You've got $100,000 in real estate equity, that's the green. You've got $200,000 in gold bullion, that's the yellow. And you've got $200,000 in a note. Well, we know that gold is a currency hedge. If the currency collapses, whatever currency you're denominating your loan in, you can pivot out of gold into any currency you choose. And so it's a great kind of base to be able to pivot into other currencies. It's liquid. There's usually a bid on gold in pretty much any currency in any market. It's private. Nobody knows you have it. It's portable. You can take it away. It's separated from the property. So there's a lot of advantages to gold. It's a metals conference. I probably don't have to sell you on that. The notes give you a fixed dollar value. When the price of the property goes down, the amount owed on the note does not. And the notes are typically secured by properties that have anywhere from 20 to 40% protective equity. So real estate can go down a long way before your collateral's no good. It's collateralized, which means you're either going to get the income or you're going to get the property. And you've got multiple exits. When you take the property back, you can sell it and pay the note off. You can operate it as a rental property and collect the income. You could sell it again on an owner carryback and generate a new note with a down payment. That's my personal favorite because you get some down payment money, which reduces your basis in it. But you have multiple exits. Notes are fantastic. Real estate notes are fantastic. You still have exposure to real estate equity, but you've reduced it by 80%. Now you've only got 100,000 instead of 500,000. So I could make the argument that that's a better portfolio mix, especially if you're going to have a credit market collapse. If the $100,000 of equity in real estate goes away, you still have the $400,000. And if past is prologue, it's possible that the increase in the gold value will far offset the loss in the real estate. And at the end of the day, you don't care because if you still own the property, you either still live in it or you still collect rents on it. You have all the benefits of owning it and you just wait out your 10 years or whatever it's going to take for it to come back. Okay, so let's do the math on the income. The interest, let's say you use a 6.5% note on that loan. It's going to cost you $26,000 in interest. And let's say you invest that in a note at 9%, which means you're going to bring in $18,000. You might be able to do better in today's market, but I know of a place for sure that you can get 9%, very, very steady. So you're going to have a net interest expense of $8,000, which is deductible. If you're in a 35% combined tax bracket, you're going to get $2,800 tax credit. And so your net is $5,200 a year to insure $400,000 of equity. That's effectively what you're doing. Think of it like an insurance premium. Okay, remember, you still own the subject property. You still get the tax breaks. You still get the inflation of the rents if it's a rental property or the value, the owner's equivalent rent if you use it personally. And if the price appreciates, you get that too. You haven't given up anything in practical terms. You've just recharacterized your balance sheet. But the other thing is you own the debt. So again, it's in front of the equity. You have multiple exits, as I stated, and you own the gold, which is equity separate from the property. You've got upside in dollars because it moved inversely to real estate in the last crash, and it's liquid to any currency. So there's a lot of reasons to consider doing this. So let's take a look at what the actual cost of this insurance is. If you take the $5,200 against the $400,000, it's costing you 1.3%. It's a 1.3% insurance premium. Now, if interest rates move in your direction, you might be able to refinance that $400,000 debt, bring it down, and then you end up actually with positive cash flow. I used to teach it where you'd borrow at 4 and invest at 8, and the gold was free. So it just depends on the environment. But rates can change and improve your cash flow. Gold's easier to borrow against in real estate, so you're still liquid. You can still borrow, but you just borrow against the equity in your gold instead of the equity in your real estate. I think that Rick Rule's new bank, Battle Bank, is going to be making those kind of loans. I talked to him at the New Orleans Investment Conference. More people are coming online who are willing to accept gold as collateral and make you a decent loan. And an alternative to a high yield note for that income could be a rental property in a non-bubble market. So if you're a real estate person, you know you can do a lot better than 9%, but it just depends on the market. So I'm not going to spend a bunch of time on that. So the question is what's coming on the backside of these rate increases? I don't know. If Danielle's right, credit market collapse could be in the cards. Here's the thing, you don't want to be this guy. You don't want to be deer in the headlights. You don't want to not have a plan. You don't want to have not thought about it. It's like having a fire and not knowing where the fire exit or the fire extinguishers are. You got to have a plan. Now is the time, as John F. Kennedy famous said, the time to repair the roof is when the sun is shining. Okay? So the bottom line is, if real estate crashes again, which you could make the argument is happening, gold can save your net worth. And this is a practical, tactical strategy for how you can do that. I've got ideas and resources free on our website, realestateguysradio.com. 7 secrets to getting max cash out on your refinance, how to invest in private mortgage, or how to generate consistent incomes through real estate notes. I'll tell you how you can get all that in just a minute. We produce a conference every year, our annual Investor Summit. We've had people like Dr. Chris Martinson, George Gammon, if you follow him, Brian London, who runs the New Orleans Investment Conference, a whole bunch of people. So we don't just talk real estate, we talk macro to Main Street. Real estate just happens to be the foundation of a real asset investing portfolio. We've been doing it for 20 years. We're going to be in beautiful Belize. If you're interested, just send an email to summit@realestateguysradio.com. We'll teach you about that. Lastly, this is something I'm super excited about. I feel like right now it's urgent that we begin to train people at the Main Street level. So we just launched in January our Investor Mentoring Club. And this is just an online where we get together and we talk about all these things for about an hour and a half, and then you go into either virtual or physical breakout rooms with a club leader. We've got clubs all over the country and more opening. If you're interested in learning more about that, you can send an email to imc@realestateguysradio.com. It's cheap. Like $47 a month for the virtual. It's just got to cover the costs and be scalable. We've got to get Main Street out of Wall Street. Wall Street's dangerous right now. We've got to reduce your dependency on credit markets. And for most people, their real estate is their top asset, and they have no idea how to insure that equity. I think this is a strategy that many of the people who follow us are utilizing. So if you send an email to that address, VRIC@realestateguysradio.com, we will send you information about all of it. Nothing to sell you really to speak of. I just want to inform you with good ideas. You can hear the podcast, realestateguysradio.com, and look forward to seeing you on the radio or maybe at the next conference. Thank you so much for your time and attention. Really appreciate it.